Taher Badshah joins us now. Let's take the conversation forward. Taher, 15-20 days ago, the general word on the street was that market will not do anything special. In the run-up to the election, there would be volatility, there would be uncertainty, and we should not expect this market will scale up to a new high. What has changed? Why everyone has been caught with a rather dim or a bearish view, and markets have surprised us?
Well, so I think we've been holding a slightly different view since the past some time, and we've been relatively more constructive on the market. And I think we've spoken on a few occasions earlier as well, where we've kind of been advocating that these are conditions of the market which are very similar to what appeared in 2014, and there was anxiety, there was confusion, there was a big preceding mid and small cap correction, and conditions were exactly the same. And I think what has probably changed is what probably the market has not as much focused on has been the earnings recovery cycle, and that is something which we need to probably focus on a lot more on rather than the ballot. And to that extent, I think that's where probably the anomaly lay. Conditions for a recovery in earnings continue to kind of remain strong. We've not seen earnings intensity or magnitude being of the nature that one would desire, but incrementally things are looking up, and the nature of the results and the nature of the result season of the last couple of result seasons do tend to indicate that the expected earnings recovery is on the way. So I think market just about kind of overlooked that for a while and caught up its attention in many of the other geopolitical related issues. I think reality has now come back, and that's what has probably led to the market sharp move in the market in the recent past.
Where do we go from here? Do you think this is as good as it gets, and one should, if you're a tactical guy, use the strength to your advantage, raise some cash ahead of numbers? One should not get carried away because suddenly the terrain is looking green.
No, I would like to think that we still have legs in the market. Of course, there's been a beginning, and we've seen a very sharp move in a very short period of time, and that typically tends to be unnerving for many market participants. But this is generally how the market's conduct happens to be, especially when it comes out of a groove after a very long period of time. But I think, like as I said, if one focuses on where we are in the earnings recovery cycle, then I think we will come up with better conclusions about the market. And that is what you need to be focused on. So we are relatively more convinced about that unfolding over the next couple of years. Conditions, like as I said, from a macro perspective are also falling into place. We have these one or two events which we need to clear. Many of the other events in the past have kind of behind us. Liquidity situation in the market is looking reasonably okay. So market has kind of borne a lot. I mean, many events, many of the negative developments in the last 6 months have been kind of absorbed by this market. So to that extent it was kind of coming that any of the positive news, and it would get very quickly priced in.
Let's take a look at some of these energy names and get your view in as well. I noticed that you have some select picks in that pack, and I'm just wondering if you'd widen your selection there in that basket or not at a time like this. Recently, we've seen strength in some of those stocks and steady buying. Today, of course, they're taking a breather. What's your view when it comes to the oil and gas pack?
So I think we are kind of incrementally constructive on the oil marketing companies as well, especially from a contrast standpoint. I think quite a lot of the negatives appear to be priced in. To us, it doesn't appear that oil is going to make a lot of headway outside of this band of between $60 and $75 over the next some time. And the likes of the OMCs are reasonably priced, or they are cheap enough now. Compared to where they were earlier about a year back, and I think the steady price increases that they've taken kind of giving them enough cushion, even if oil were to probably spike up by another $10 odd or $15 odd. So to that extent, I think there is merit in some of these oil marketing companies. So that pack we are incrementally getting a little more constructive more recently. We have our larger exposures in some of the other oil and gas companies including the heavyweights, and also some of the gas pipeline and utility kind of companies where we find value. So we have a fair bit of positioning in this space, but all for different kinds of reasons. We've got some of these last mile gas utilities also, but those are more from a consumer's perspective as a consumer business. So we like different businesses for their own reasons. Aggregate, it adds up to probably being an overweight situation on the sector, but this is more a culmination of the bottom-ups.
I'm looking at, some of the holdings as well, and I see L&T on the radar. We have seen quite a bit of fervor here, Taher, of late, and now the fact that it's, set to defy uncertainty, the order guidance likely to be met. They have bagged sizable orders as well so far. What is the future projection for L&T in terms of targets as well?
Well, it's a little hard to comment on individual stocks, but yeah, I mean, this is one of the stocks that we do have in our portfolio. So to that extent, you're right, and we are essentially this name is for us and for by and large most others on the street is a play on industrials and the infrastructure space. So that's how where we are positioned from that perspective. We think. Our attraction towards this name is more from the point of view of the balance sheet improvement that we've been consistently seeing over a period of time, but along with which now conditions are developing for the industrial stroke infrastructure space to kind of start delivering, especially in terms of core business as well, and valuations are reasonable. I wouldn't say cheap in this space. So that's how some of these names, including an L&T, which figures in our portfolio.
Corporate banks. You're bullish on corporate banks. Now the world is bullish on corporate banks. What is the underlying thought here? If I look at the credit offtake number for corporate banks, they don't look strong. There is merit in believing, Taher, that they will participate in the next corporate or capex cycle. But Taher, the problem is that the next corporate cycle is yet to start. Looking at the market conditions and the fact that we are 6 weeks away from the election, I don't think any corporate will start committing to capital for next 3, 6, 7 months.
Yes, so you're right from that perspective that we're not going to see many of these corporate banks. I would not be too expectant of many of these corporate banks actually going the way of lending into the to projects and to the infrastructure space in a big way. We don't really think they are configuring themselves for the next 3 to 5 years from that perspective. But by and large, the credit cycle in any case is improving, and these corporate banks are changing the hue very subtly though, but they are getting a lot more consumer oriented and let's say a lot more working capital lending oriented. So I think these corporate banks are not going to be the corporate bank. We might want to tag them as corporate banks, but they may not look like corporate banks the way they have been traditionally seen in the next few years. So I think we have to buy them. For us, they have been more like value-related ideas. We've been holding them for now more than a year, or close to about 2 years now. And we've seen the ups and downs, but I think there's still value, and we still see cheapness in some of them. In one or two, we also see the possibility of growth characteristics emerging. And we are seeing the credit cycle in any case improve, if not as much from the project loans point of view. So that is our attraction in these banks. We are buying them for that reason, not for the fact that they are going to be participants of a wider infrastructure stroke corporate cycle, corporate investment cycle.
Taher, would you agree that a lot of the PSU names, let's take a Coal India or an NTPC, are starting to look fairly attractive now? I mean, take a look at those dividend yields, over 5%. Valuations are also looking good. Would you agree this is the right time to get into some of those counters?
I would think so. Especially from a value perspective, we have come across a couple of names which we ourselves have reflected in our portfolios, which do provide that opportunity. Some of them are really very cheap, even if we know that we are talking about some of these names which are cyclical in nature or are commodity businesses. Even if you were to probably budget for a weaker commodity cycle, when we look at them from the point of view of where they are on the cost curve, etc., we find that our market is probably pricing in the worst or not so great scenario from a commodity cycle standpoint, price cycle standpoint. And valuations, like you rightly said, are also turning comfortable. Not just comfortable, in fact, turning cheap, I would say. So to that extent, we have reflected some of these names in our portfolios as well. So yes, clearly opportunities are emerging in this area, but from a value perspective, not as much from a growth perspective.
A quick status check on where we're at, 11,311 thereabouts. The broader end of the market is sort of flitting between the green and the red right now. We're up nearly 50 points on the Sensex as we speak. And in terms of sectors, well, you're garnering a helping hand when it comes to real estate as a pocket, so that's standing out. IT is doing quite well, up about 0.6%, not too bad for pharma. And the Nifty Bank, which was perched at those record high levels yesterday, is at 28,876 thereabouts. From the broader end of the market as well, I'd just like to flag out some of the movers. Take a look at the tire stocks, which are having quite a field day today. The likes of Apollo Tires, JK Tires, CIAT, MRF, that entire basket is holding out quite smartly. Indocount is firmly in the green. Something like, Mahindra CIE, JM Financial, all of those stocks are gaining traction. While yes, the real estate pockets merits a mention. DLF, IBREL, some of the infra names like Kolte Patil, IRB Infra as well are holding out. Taher, what's the sense that you're getting when it comes to the real estate space? It has been beaten down. It was one of the key underperformers last year as well. Do you think that there is going to be a bit of conviction coming into the sector now?
We honestly have not really developed any great view around this sector, nor do we own any names in this space at this stage. It doesn't, they still don't fit some of the requirements of our investment framework, and to that extent we have found it difficult to come up with bottom-up ideas. I mean, this is a sector where you need to just be a lot more stock focused. I don't really think it's going to be a sector-wide rally, if at all this space were to show color. So you have to be very, very choosy, and we've not really yet come across any ideas in this area. So not to suggest that this is not something which will not do well, but it's just that it still doesn't appeal to us.
All right. Thank you, Taher. Thank you very much.